All right, so this is how to use IRAs and 401ks to invest in real estate. So, welcome. All right, quick disclaimer. So, I'm not an investment advisor. This presentation is just for educational purposes. If you're going to make an investment, make sure you're consulting with your own consigliaries, your tax attorneys, your real estate attorneys, your CPAs, whoever, if you've got mentors. But this is just for information purposes only, and just to kind of spread awareness on what the possibilities are out there, especially when it comes to investing in real estate. But this also goes really beyond real estate, and you can use these techniques and these strategies to invest in anything, and we'll talk about that as well. So, all right, a bit about myself. So I grew up here north of Boston, that's where I am right now. So spent all through my college years in the Boston area, and then took off. I got a scholarship out of high school for the Air Force ROTC. So then I went and I got an aviation track. So I went and tracked the B-1 bomber out of flight school. Got about 2,500 hours in that jet and 3 deployments under my belt. So that was my career, and now I've shifted out of that. While I was active duty in the Air Force, I began investing in real estate. So that's really where my interest in real estate began. Was while I was still active duty, I bought a duplex and I house hacked. So I had a renter in one side, I had a roommate, and I was living rent free, bill free. It was great. So that's what started my interest, and then I bought another duplex and another duplex. So and that brought me to where I am today. When I got out of the Air Force, I was pretty fortunate that I had started investing in Bitcoin in 2013, so way prior to the major run up there. So that gave me some opportunity to really just take some time off. I took some time off after the Air Force, and then I decided, hey, I like being a landlord. How do I do this full time? How do you become like a full on real estate investor, right? So that's led me to the path I am on today with Mach 1 Equity. I founded that about a year ago. So pretty excited for the opportunity that's on the horizon now, especially with everything going on with the economy. As sad as it is for our country, there's going to be opportunities, going to be fortunes made, and I want to be a part of that. I want you guys to be a part of that. So, all right, so let's get into IRA specifically. So just kind of an intro to IRAs. Obviously, you guys are probably familiar with, whatever IRA you have. So you have your traditional IRA, where you're essentially deferring that tax until you go to withdraw. The Roth IRA, where you're able to make tax-free withdrawals down the line in your retirement years. So you're taxing now, and you're able to do tax-free withdrawals later in the Roth. And then you've got some of your employer plans, your SEP, your 401k, your simple IRA. And then there's other education savings accounts and health savings accounts as well that also kind of fall under this umbrella that can be self-directed. So when it comes to the self-directed IRA, what is the self-directed IRA? So it's actually, there's no self-directed IRA. It's not a thing on its own. What it is those IRA plans that you transfer to become self-directed. So it's kind of a marketing term, but what it is you taking ownership of that account, and it gives you total control, gives you decision-making authority to determine what it is you're investing in, as opposed to, a financial advisor, one of the brokerage firms or something. So what that affords you is it allows you to invest in alternative asset classes. So, this is anything outside the traditional stocks and bonds, things like real estate or even precious metals. And we'll talk about what's covered under that. But I think the big advantage that I see is that it allows you to avoid the stock market kind of roller coaster. I mean, we've seen just in the last few months, the market crashed 30, 40%, and then it's had this meteoric rise and recovery. But I don't know about you, it doesn't seem to check with reality to me. It doesn't pass the sanity check, because we have still 30 million people without jobs in this country, and the stock market is testing all-time highs. We've got stocks that are blowing past their all-time highs, and there's a lot of money coming into the marketplace. The Fed is increasing their balance sheet and providing liquidity, which is kind of propping some things up as well. So, there's a lot of talk about, hey, are we in the midst of a giant bubble right now? And a lot of people like myself, we don't want to get caught with our pants down and be exposed to that. So getting into, alternative assets like real estate, but they're proven, safe, steady investments that you can use to build wealth towards retirement. So that's, for a lot of people, a great option. So like I said, you could do private placements like a syndication, precious metals. But of note, it does still require that third party. So, you may hear it referred to as a custodian or an intermediary. So there's companies out there that, you basically have an IRA, self-directed IRA professional that it acts as the custodian. So you work with them to transfer your IRA into a self-directed IRA, and then they are helping you perform the transactions at your direction. So, all right, so why do we want this? Like I said, a lot of Americans' retirement planning is kind of built on this lie that the stock market can generate consistent, safe returns, 8% over, 20, 30 years. The problem is that math is often right, but the assumptions going into it are wrong. And especially today, a lot of experts see the stock market, even pre-corona, as a bubble. Just going the last 20 years, the way they're valuing these stocks compared to the market cap of the company often doesn't make sense. Right now, Tesla is a great example. Stocks at like $1,500 a share. They are the biggest auto manufacturer according to market cap, like $250, $260 billion, but they make, a fraction of the cars that Toyota does, right? So it doesn't really make sense how that stock is being valued. So, is that a bubble that's going to burst? It's pretty likely. So for a lot of people, their IRA is a great source of capital to tap into. If they want to get into real estate, they can use these funds that are otherwise kind of locked up in a way. So I think a lot of people, they look at their IRA funds as, they're illiquid, right? Even though you can use them to invest, you can't use them personally for yourself. So for a lot of people that say, hey, real estate is a long-term investment, I'd love to get involved, I just don't have the capital because I want to keep my savings, especially right now with everything going on where jobs are maybe a little bit shaky. People are saying, I don't want to touch my liquid savings account because if I lose my job, I might need that money, right? Whereas their IRA, they can't really use that money anyways until they retire. So it's a great opportunity to put that money into real estate and allow it to grow through a real estate asset. And that really is a much better diversification plan than what is typically offered by a brokerage firm. And often you're in these different funds, and yeah, technically on paper you're diversified, but the stock market tends to move as cohesive element almost. So you'll often see with stocks, they're down for the day, and people say, well, why is this stock down 5%? Oh, well, the market dragged it down. So that's kind of how the stock market works. So even if you're diversified across funds or within some mutual fund or ETF or something, it's still generally gonna follow the market at large. So you're not truly diversified. Whereas you put it into a hard asset, a real asset like real estate or gold or something else, then you're really diversified, right? No capital gains. So that's an advantage of these IRAs, right? Is you're not subject to capital gains. They're taxed differently, taxed as income. So you can make investments and not worry about the capital gains exposure to that. And then of course, like I said, you're tax deferred or even in some cases tax-free growth, depending on the type of retirement account. It also allows you to invest in what you know. So a good example might be if maybe you're a professional of some sort, like a skilled tradesman, maybe you're an electrician, and you've got someone that works for you and hey, this guy's a hot shot, he's going places, he's young, we've trained him, but he's going to be off on his own within 3 years. Instead of him just going off and doing that on his own, maybe you say, hey, you know what? I want to invest in you. I will use my IRA funds to invest in your business that you start up, provide them seed capital, and now your IRA owns a portion of that business and can benefit from that, right? So that's a good example. Maybe you just have local opportunities, certainly in real estate, that's a local investment market. So you just have kind of a line on a good deal and you say, I want to take advantage of this, and you need capital, you can use your IRA funds. So it allows people get out of the umbrella of the large brokerage firms in the stock market. So what can you invest in? So wide array of things. You can buy single family homes with it. You can invest in multifamily properties or invest in multifamily through a syndication or private placement. You could buy commercial properties, land. I just like that quote. It's the only thing they're not making more of, right? So lot of argument to invest in land long term, especially if it's an expanding area and you can capitalize on that. Precious metals. So you could buy gold, silver, whatever. You could buy the physical gold itself. If you're doing that, I do know if you want to buy, for instance, gold bars, you do have to have it held by a third party. So you have to find somebody that is there, and there's people that do that. You can find that. They basically hold it almost like a safe deposit box. So you direct your custodian to purchase this gold through whatever gold dealer, and then it never actually touches your hands. It just goes right to this third party that will hold the precious metal. You can invest in notes, mortgages, tax liens. So you can invest in things that are sort of related to real estate, but maybe not directly in real estate. LLCs. So like I said, if you just want to invest in a company, you can do that. And even Bitcoin. So people are starting to invest in Bitcoin. I don't really recommend that maybe for your retirement fund, but hey, there could be a lot of opportunity there. I'm bullish on it, but that could kind of go either way. So that's a little higher risk factor. But again, maybe if you're young and you've got some retirement funds, and you say, hey, I got 40 years to make it up, but this could go boom. Let's take it to the moon. Hey, maybe that's the route you go. So, but there are some things you cannot invest in. So collectibles, you can't purchase art or antiques or stamps. Booze, you can't buy a wine collection and claim that that's going to appreciate over time. Although I'm pretty sure there are funds that you can buy that have some of that exposure. So maybe you go that route. Coins. So you can't buy coins unless they're investment grade. So if it's basically a solid gold coin or silver coin, I think there's a certain percentage it has to be. You'd have to look into that a little bit, but you can buy those coins because you're investing in the metal itself, but you can't just invest in a rare coin. Can't do life insurance, and you can't invest in S corps because of their tax structure. I guess there's some sort of conflict, so the IRS doesn't allow you to invest in S corps. All right, so some of the rules, there's definitely rules with this, like beyond just what you can't invest in, but kind of how you invest. So there's this concept of prohibited transactions. So you're not allowed to do any self-dealing, it's called. So you can't have an immediate gain for you. You're investing for the IRA. So almost you have to think of the IRA account almost as its own being. That IRA account is the sole beneficiary of these investments. It's not you as an individual. So, which is kind of a quirky thing about IRAs in general is it's not really your account, it's the government's account, and you're just the beneficiary. So I don't know, to me, I just think that is like a clue of how they made all this stuff, and a lot of it is just to benefit the bankers, because there's tens of trillions of dollars in these IRA accounts. With the brokerage firms, only about 4% of IRAs are self-directed, but I think that's increasing as people become educated. So you can't buy, sell your own properties to or from yourself. You cannot rent from yourself. So if your IRA buys a property, you can't rent that property. You can't, buy a vacation property that you Airbnb and then go stay there once or twice a year. That is no. So you can't live in it. Like I said, all the rent and income stays within the IRA. So you can't purchase a rental property and then siphon off the cash flow and then just keep the capital gains with the IRA. It doesn't work like that. All that rent has to go into the IRA account. So what I call the handyman rule. So you're not allowed to work for that investment basically. So if there's something like if you buy a home and it needs a renovation, you can't do the work yourself because then you're contributing that immediate gain. So you have to hire people, which is kind of what it comes down to. So that's a downside of that. And you can't borrow against it for your own. You can't borrow against the IRA to pay off like your personal mortgage or something. So there is exceptions to that. So I think a Roth, you can borrow up to 50,000 or 50% of the account balance for yourself. So that's an exception. And then also there's disqualified persons. So basically it's your ancestors, descendants, your spouse, and any fiduciary. So your parents, grandparents, your children, your grandchildren, they are disqualified persons. So you can't do transactions with them and they cannot be involved in, again, you can't hire them to be the handyman or your property manager. That's a no-go as well. And then your fiduciary. So if you work with a CPA or an attorney of some sort, you can't do business with them within that IRA. So if you name somebody a beneficiary, because you can theoretically name anyone a beneficiary. So if you have a friend or someone that you name a beneficiary of your account, they can't be involved either. So bottom line, it has to be arm's length. It's kind of how they determine that. Oddly enough, siblings are okay. So you can do whatever you want, it sounds like, with your brothers and sisters. So I just thought that was interesting that wasn't included there. So, all right. All right, contribution limits. So there are obviously limitations to how much you can contribute to all these IRAs. So all those types of IRAs that we started with, that is one of the main differentiations between them is what you can contribute, right? So for 2020, your IRAs, it's a $6,000 limit unless you're over the age of 50. You can do what's called catch up, which gives you an extra $1,000 that you can contribute. The big one to point out is the solo 401k. You can see the difference there. $57,000 is the maximum contribution limit. So if you're able to set up a solo 401k, and really all it takes is setting up an LLC for, a side business or whatever that business does. You did not have to have a successful business. So if you set up a business to sell candy bars outside of Walmart, maybe you obviously confer with a lawyer or a CPA, but there is ways for pretty much anyone to take advantage of that solo 1K. So a lot of people that, hey, they want to start making large contributions to their IRA, they can set up a solo 401k and really maximize their contributions. So, and then good practice is making those contributions early in the year so that you're maximizing that tax benefit, right? All right, but there are penalties for withdrawing against your IRA. So most retirement accounts require you to wait until retirement age to use your savings without incurring a penalty. So any withdrawal you make before the age of 59 and a half is penalized at 10%. So there are exceptions. The exceptions are if you have a disability, if you're using it for education, if you're using it to pay medical insurance after you lose your job. So yeah, it's crazy that some of these require an exception, but yeah, your first home purchase, I think you can use up to like $10,000. If you're military, if you have a medical emergency, you need to pay some bills. Oh, and they give you the opportunity to use it after you're dead. How nice is that, right? So your estate can use your IRA to help cover your funeral costs and things like that. So I just thought it was funny that they pointed that out, right? So, all right, I think that's all I wanted to say for that. All right, there's also required minimum distribution. So this is another rule you got to be aware of. So from the age of 72 onward, there's required minimum distributions from your IRA every year. So this is up actually from last year was 70 and a half, so they increased the age. This does not apply to Roth IRAs, but your traditional IRA, it does apply to. So there's a calculation, basically it's your account balance as of December 31st the prior year, and then divided by your life expectancy, which comes from this IRS uniform lifetime table. So you'd have to look that up, and that gives you your required minimum distribution each year. So if your required minimum distribution is say $10,000 a year, but for whatever reason you only use 5,000 of that, that remaining 5,000 is then taxed at a 50% rate. So it behooves you to take that whole required minimum distribution, right? But I mean, this is just kind of a limitation. This is the government just trying to get their taxes out of it, right? So that's why it doesn't apply to the Roth, because it's untaxed anyway. So they don't really care, but they want the taxes and the income from your retirement account once you hit retirement age, even if you don't need it. So, you know, another downside to the way they set up this program. All right, so how do you open a self-directed IRA? So it's actually pretty easy. So first, you just open your account. You have to choose a custodian, find an intermediary that deals in these things. But once you do and you're comfortable with them, obviously you want to do a little research, talk to people that have done it and see who they're happy with. But it's a pretty easy application process. So, you know, you might have to spend 15 minutes filling out an application and going through, you know, getting them the information that they need. And then they'll provide you with account information, usually same day that you start that process. And then it's just a matter of funding that account that you just set up. So you can do a direct transfer from a current IRA to your new self-directed IRA, or you can roll over funds from a previous employer plan. So if you had a 401k or 403b, you can roll over those funds to that account as well. So there's a bit of a distinction there just because of tax reporting purposes. You have to report if you do a rollover versus a transfer of funds, but it's tax-free. It's tax-free to move it from a typical IRA to a self-directed IRA. So this is a tax-free event. And then of course you continue to make your annual contributions to that account, right? And then from there you're ready to invest. So you just got to find an investment that you like, and then you direct your custodian to purchase or make that investment. So yeah, it's pretty simple. I mean, from there, the custodian is going to work with those other parties involved. So they're kind of signing on behalf of the IRA with the, you know, the escrow agent or the closing company. You know, obviously it's going to depend on what you're investing in, right? But they're kind of doing all the paperwork, I guess, for it, right? And then you can actually start that process before your account is even funded. So if you've opened the account and you've already identified an investment, you can kind of start working with them, knowing that, hey, I'm in the process of transferring these funds, because it could take, you know, a few days or even a few weeks, depending on how complex your personal situation is. That's going to be really dependent on what your specific situation is. It's going to vary by individual to individual. But the bottom line is usually it's fairly quick process. But if you know you're going to use this, you want to get that account set up and funded prior to even finding an investment. There's no advantage to waiting until, hey, I've identified this syndication that I want to invest in, but hey, they need the funds in 1 week. It's going to be tight, right? So just get it done now and you'll be ready to go. All right, so this is important to highlight though. So UBIT and UDFI. So this is, if you're investing in real estate that is leveraged, you could be exposed to this, or a business. So we have basically two things that kind of fall under this one umbrella. So unrelated business income tax. This applies to business income, not investment income. So that's why it doesn't apply to like a dividend or something like that. But it can apply to some private equity investments. But basically a good example would be if you invest in, say, a restaurant or something, and they're providing you monthly share of the profits. That's unrelated business income tax. So you're actually getting income from a business that you've invested in, and that is going to be taxed. And then there's what's probably more concerning for most of us if we're investing in real estate is this unrelated debt financed income. So this applies to income from leveraged real estate investments. So if you use your IRA and you buy a single family home outright, all cash, then it doesn't apply to you. You're not taxed on the income from it. It's just, whatever the IRA rules are, right? So, which is taxed as income. But if you buy a property and you leverage it, so let's say you take out a 70% loan to value, so you're coming up with 30% of the cash, and then 70% of that purchase is using debt, bank financing. So you're going to be taxed on 70% of your returns, right? So if you earn 100,000 from the investment, 70,000 of that will be taxed by this unrelated debt finance income. There's also a limitation that when you're investing in real estate with IRA funds, it has to be a non-recourse mortgage. So that's another one too, that it's not an issue. I mean, that's available, but you just have to make sure that you're using non-recourse, because otherwise you're lending your personal credit to your IRA. So that's where, again, you're crossing those streams, right? So, but the thing about the UDFI is you're able to use depreciation against it. So, and we'll talk about one of the downsides of investing with an IRA into real estate is that you don't get a lot of the tax benefits of just that come with real estate in general, but you can use depreciation to write off that UDFI. So generally speaking, it's usually quite negligible for most people, and it's not something that should scare you off from an investment, because you're still going to look at, well, even with the UDFI, am I doing better than having it in a mutual fund or wherever? But you do need to be aware that that exists, right? Now, of note, this is not applicable to solo 401ks. So if you set up that solo 401k, if you own your own business or you've got a side hustle or something, you can set up a solo 401k, and you don't even have to incorporate. You can just do it as a sole proprietorship, but that is not subject to this UDFI, so you don't even have to worry about it, right? So that's one reason those solo 401ks have become very popular with real estate investors, is for that reason. All right, so big picture, now we've kind of gone over what it is and what the kind of rules are. So I just wanted to look at kind of a side-by-side pro and con of using an IRA versus just using your personal funds to invest. So the pro with an IRA is no income taxes due on the gains. So it's within an IRA. So it's the IRA that is seeing those gains. It's not going against your personal income for the year, right? Your personal tax returns. So you're able to grow it either tax deferred or tax free within that investment, right? So that's the advantage of IRAs in general, right? And then it's an alternative source of capital. So for a lot of people, like I said, they have maybe their emergency savings or liquid capital available, their dry powder. But hey, right now things are maybe a little shaky on the job front, so they want to keep that safe so they can use their retirement funds to invest. Or maybe they just don't have any other capital, but they say, oh, you know what, I have been contributing to my IRA for 10 years, but I'm looking at it and it's only earning 3 or 5% a year. Hey, I'm going to put this money to work elsewhere. Real estate's a great opportunity, right? And like I said, it's a liquid anyways. You can't use that money for anything but investing. So you might as well make sure it's in an investment that's working for you and getting a solid return. And then you're the approval authority. So you don't need anyone's approval because you own it. You control that account because it is now self-directed. All right, some of the cons though, you can't access that capital until 59 and a half. So that's the trade-off of investing in an IRA. You don't get any of the benefit of it for decades potentially. So even if that property's kicking off 10% cash on cash a year, it's all just going right back into the IRA. So there's no immediate benefit to you. It's all thinking long-term. Again, you can't use the property personally. So if you're just investing with your own funds, yeah, you can go stay at your Airbnb once a week or once a summer. But with an IRA, you can't. You have to maintain that arm's length. And you can't use the tax benefits that come with real estate, such as the deductions and the depreciation. The exception being that UBIT and UDFI, so which is also a con of the IRA investing in real estate, is you are subject to that. But like we discussed, there's ways to mitigate that, and generally it's not a big deal. All right, so if you're using personal funds, what are the pros? Well, you can take that income now today. So if you're earning cash flow on day one, boom, you've just improved your income, right? So that's a benefit for a lot of people. That's important. You can use tax deductions and depreciation, so you get the full benefit of the real estate tax advantages. You can borrow without the non-recourse requirements, so you're not limited in what kind of debt you can take on. You can get fully recourse debt if that appeals to you for whatever reason. You're not subject to that UBIT tax, and again, you can use that property personally. So that's definitely pros of just using your own money. Some of the cons are your income and gains are subject to income and capital gains tax. So you're not sheltered from those taxes. You're subject to them yearly basis and capital gains when you sell the property. Now, you still have opportunities to defer a lot of that through 1031. So if that applies to you, then great. Sometimes that's not an opportunity, especially if you're in like a private placement or a syndication. Sometimes that's not available. But often, a lot of people will continue with the real estate strategy anyways, because even with those tax exposures, they're still coming out ahead over other asset classes. It's a liquid, so yeah, if you tie up your cash, it is an illiquid asset. So that is one of the downsides of real estate, is you can't access that equity if you need it for an emergency or something. Where some people, if they have their IRA, even though they may pay a penalty, unless it meets maybe one of those exceptions, if it's an emergency, it likely will, then you can at least access some of your IRA capital. But if you got all your cash tied up in real estate, it is a liquid. And then you're open to liabilities for claims or from creditors. So an interesting thing about your retirement accounts is they're very protected. So a cool example I heard recently was O.J. Simpson. So you remember O.J. Simpson, he dodges the murder rap. He avoids, prison, right, and going to jail for murder. But he was sued in civil court by his wife's family, and he lost. So they got everything except for his pension, because your retirement is protected, and it's very difficult to get that taken away. It might even be impossible in a judgment. I think the only time that your retirement can be taken from you is in cases of fraud. So if you defraud somebody, then it's subject to claims. Otherwise, it's free from that. So just another advantage of your retirement accounts. So all right, so that's the overview. That's the formal portion of this. I just wanted to kind of show this is a project I have that is live right now. This is a medical office development in Loveland, Colorado. And we actually have investors in this that use self-directed IRAs to invest in the project. So I thought that was kind of cool and relevant. And if you're just interested in medical office in general as an asset class, happy to talk with you anytime. It's an interesting asset class, especially coming out of this pandemic. I think it's going to see a lot of additional exposure and interest and investment. So if you haven't already, you can sign up at my website. I put out this monthly economic and real estate market report. So I do the written report. Usually it's 5 to 10 pages, and then I'll do a webinar on that as well for people that prefer to get it that way. That's all my information there. So if you haven't already chatted with me, definitely go to my Calendly, set up a call, and we can just chat, get to know one another, or just we can talk about whatever. If you have additional questions about IRAs or real estate in general, yeah, love to chat and grow the network. So if you guys have any questions, we can, Victoria, I'll be sending out the recorded version probably tomorrow or Monday. I have to kind of render it and trim it down a little bit for YouTube. So once it's loaded up onto YouTube, I will send it out to everybody that has registered. So you guys will have that. And that's true for all my future webinars. It always goes out. So even if you can't attend something, but you see a topic that you're interested in, I had a few people reach out about this one. They couldn't make it because, I get it, it's Saturday and people have lives, but you'll always get the replay. So that way you can access it at your leisure. So I think that's just a good benefit of modern technology, right? You're welcome. Capitan, is it Capitan or Captain? I don't know. All right, guys. Well, if you have questions, like I said, I'll happy to answer them. Otherwise, enjoy your weekend. Hope you learned something. Hope it was valuable for you. Like I said, I know this was a good learning opportunity for myself. Learned a few things, but at the end of the day, like I said, once you break it down and get into it, it is pretty straightforward. But everyone's gonna have their own personal situation, and there's gonna be some gray areas that you got to look at, and that's where those professionals really come into play as well. So make sure that if you're leaning towards this, make sure you're reaching out to some intermediaries. I know there's Advantage is one company. There's another company in Trust that I've heard. So there's a bunch out there. So just talk to your network and figure out who people have used and like, and yeah, go for it. Cool. All right, guys. Looks like that's it. I think that's all we got. So if you have any questions that come to you, feel free to reach out anytime on email, Facebook, Messenger, however, and happy to chat or follow up with you as well. So, all right. Take care, guys.